Hi, welcome to the One Heartbeat podcast, sponsored to you by One Heart Insurance Group. Chaos, conflict, and confusion. Those are three things that I always talk about. Why is that so important, and why is it important to be able to avoid those things? Have you ever seen a family that's fussing and fighting during the funeral? True scenario. Family goes into a funeral home and they're talking about the color of a casket. And they could not agree on the color of a casket. The sister gets upset and she starts fussing at the brother. And the brother starts fussing at the sister. And the next thing you know, it's the Thriller in Manila right there in the funeral home. Who wants that? No one wants that for their family. So let's talk about chaos, confusion, and conflict and how not to let that happen by planning for what you need, with the funeral. Today, I really want to speak about life insurance in general. There are three basic types of life insurance. And again, most people are not educated on the three types of life insurance. Either they are told that one type of life insurance is better than another type of life insurance, or I don't want that kind of life insurance, or I heard that wasn't good. Well, how do you know? Because no one is ever really educated on that, so people just kind of go on what they hear from different people. But the true thing is really understanding and knowing that there's no bad life insurance. The only difference is that you have to truly understand where you are in your point of life to buy the different types of life insurance. I'm going to focus on one type today, but let me just tell you the three different types. You have whole life, which is just what it says, because you have it for your whole life. You keep it for your whole life. Then you have term life, which also is based on its name. It's for a term, for a period of time. And then you have universal life or variable life. All of that is, considered one thing. But out of those three different types, today I want to focus on whole life. And the reason I want to focus on whole life because if any of you ever out there has built a house, you understand one simple concept. You've got to have a great foundation when you're building a house, because if not, it's not going to stand. And it's the same way when you're purchasing life insurance. You got to have a strong, solid foundation. And your whole life insurance is that foundation that you need to understand, okay? So, with that, whole life can come in different forms. It can be traditional whole life, which you may still have to go through the full underwriting effects, taking a medical exam, a physical exam, or anything like that, so that you can qualify. But the most popular kind today is final expense, which is a type of whole life. Final expense is becoming very, very popular. Have you seen all the ads on TV today, all the insurance ads from the different life insurance companies out there? And if you haven't, the only thing you have to do is sit down in front of the TV for one episode of anything, and you're going to see a life insurance commercial telling you why you should buy life insurance. And most of them are going to talk about if you're between the ages of 45 and 85 or 40 and 85, those kinds of things. Because what they're selling you is a final expense life insurance product. Why is that so important? Because right now, with the baby boomer situation, we have over 10,000 people every day turning age 65. So it is a market that is there, and you see more and more insurance companies getting into that market because it's a great market to be in. Well, final expense life insurance takes a little bit different approach. In most cases, you don't have to have any medical exams. Some companies even boast about you don't even have any medical questions or no medical questions asked. But there are some very simple things that you need to understand about all of these types of life insurance. While whole life is a good product, and whole life is the foundation of any life insurance, because you will not build any life insurance on a foundation that is not solid. So you want to buy your whole life insurance because it's there for your whole life. Just like with the house, whether it's a hurricane, tornado, fire, or anything else, the foundation is usually left standing. The same with your whole life insurance. It's going to be there. It's going to be there for your whole life. So when whatever happens, if you get sick, you get older, or anything like that, you've locked into a price. Because the one thing with whole life, it's a little bit more expensive in the beginning, but your price stays level. It stays constant throughout the whole time. It does not change on you. So that you know that when you're buying it, you're locked into that price. You don't have to worry about it changing on you. So that way you have a solid foundation, something that's not going to change, something that's not going to move on you, and you have it there, throughout. So now you have a product that you may not have to qualify for medically, because a lot of times you've gotten older, your health may not be as good, and so you have something that you can still qualify for, versus a traditional whole life product where you still have to go through medical exams and that sort of thing. But there's good and bad in each one of these things. So I'm going to tell you about a few key things very quickly so that you understand when you're purchasing final expense life insurance. One of the things that you're going to see in all of these commercials that you have on TV is they're going to say a few key things. And so I want you to listen to those, because these are things that you've probably seen a million times and never paid attention to. First thing, they may say, no physical exam. The second thing, they may say, no medical questions asked. Or look for the word modified. They may say modified life insurance. Okay? Or they may say limited benefit. All of those things basically mean the same thing. It basically means that you will have a 2-year period before that policy is going to be payable in full for the full face amount. Because you didn't have to qualify medically or those kinds of things, then you're not going to have that full benefit when something happens. So what happens is that in most cases, you're going to have, when a person passes away, you're going to have, within the first 2 years, you're going to have a return of premium plus interest versus the full amount. After that 2 years, let's say you have a $10,000 policy, then it will pay the full benefit. Versus some companies out there, you still don't have to have a medical exam or those kinds of things, and they are out there, but you have to understand that. So you can still get the coverage, and it can be what we call first day coverage, where that policy is going to go into effect immediately. So would love to tell you more about this. Please contact us. The information is on the screen below. Thank you very much for tuning in, and we'll talk to you next time.